Welcome to another edition of Your Wealth Matters. Today, we will be doing a quarterly review to the end of June. Well, we're into July now, so the last quarter, Q2 of 2026. And today, Paul Carter is joining me. I'm Maria Dawes, Portfolio Manager here at Capstone. Paul is our Chief Investment Officer. So, Paul, it's been another eventful quarter, 3 months. There's a lot that's gone on. Geopolitical tensions, oil prices, interest rates. We could focus on any of those. But let's start with the hot, pressing topic of SpaceX. Okay, so let's start with a pressing question that we're getting asked all the time. Did Capstone buy SpaceX? And maybe what's the deal with SpaceX?
Great question to start with. And the short answer is no, we did not buy any SpaceX. Now, for anybody who somehow missed it, SpaceX went public last month in what was the largest IPO in US stock market, actually global stock market history. They raised roughly $86 billion US.
Right, so it's a big deal.
It absolutely is a big deal.
Okay.
And look, SpaceX absolutely could have been an investment for our biblically informed US equity fund. We can own innovative companies, we can own technology companies, but after looking at it pretty carefully, we just decided to take a pass on it.
So give us your take on it. How come?
Well, there's really two reasons. First is simply valuation. And look, we're value investors, but that doesn't mean we refuse to buy growth companies. We're perfectly happy paying what may look like a high price today if we think that the business is going to grow dramatically over the next 3 to 4 years. But we just couldn't get there with SpaceX. The company came public at close to $2 trillion valuation, and that's roughly 100 times trailing revenue. That's not 100 times earnings, that's 100 times revenue. So at that point, you're not investing in what the company has accomplished so far. You're investing really in a dream. And at that valuation, almost everything has to go right for the company over the next decade.
It has to make a lot of money.
It has to make an insane amount of money in order to justify that valuation and for the investment to make sense.
Right.
And maybe it does. I mean, Elon Musk has made a lot of people look pretty foolish betting against him over the years. But as stewards of our clients' capital, we couldn't convince ourselves that there was enough margin of safety there.
Okay.
Now, the second issue was our biblically informed investment process. A meaningful part of SpaceX's revenue and shareholder value is tied to their social media platform X, which is formerly known as Twitter. And that's a platform where content that, shall we say, doesn't align with our values is not only available, it's actively monetized. And one of the things that we try very hard to do with our stock and bond investments is to look beyond a company's ability to generate earnings and cash flow and to ask a deeper question. How exactly are shareholders making money? For us, the answer really matters. Now, that doesn't diminish at all what SpaceX has accomplished. What they've done technologically is incredible, and I'm sure they'll continue to do some pretty incredible things. But we just concluded that, taken as a whole, it wasn't the right fit for our clients.
Okay, so that makes a lot of sense, but am I correct that we actually do have some exposure to SpaceX somewhere in our portfolios?
Yeah, we do indirectly.
Yeah.
So one of our private equity funds one of the private equity funds inside our non-traditional equity pool, or what we call NTEP, bought private shares of SpaceX from existing shareholders through a transaction on the secondaries market well before the IPO happened. Importantly, that investment was made at valuations that were dramatically lower than where the stock trades today. And that wasn't a direct decision made by Capstone. That's one of the realities of investing in private equity secondaries. Sometimes you end up owning businesses that you probably wouldn't have purchased directly yourself. In this case, though, the timing worked out pretty well. And in speaking with the manager of this fund that NTEP is invested in, we expect that they'll be looking for opportunities to monetize that position over time.
Stepping away from SpaceX just for a moment and maybe looking at the equity market as a whole, it was a pretty strong quarter for the market as a whole.
Yeah.
So what drove that? Give us some information on that.
Yeah, definitely. So honestly, it was a pretty remarkable quarter in what what's been going on with Iran and the volatility that we've seen in oil prices, as an example. The Canadian stock market was up around 7% in the second quarter. International markets were up collectively around 13%. And then the S&P 500 index in the United States was up roughly 17% in Canadian dollar terms.
A very strong quarter, actually.
Yeah, those are enormous numbers for a 3-month period.
Yes.
And really the biggest story recently continues to be AI, artificial intelligence.
Mm-hmm.
Investors are realizing that AI isn't just a software story, it's an infrastructure story. It's semiconductors, it's electricity, it's cooling systems, it's data centers. Every single AI question that someone asks eventually ends up having to run through a very expensive piece of physical infrastructure somewhere. And the companies supplying that infrastructure have seen their demand absolutely explode. And investors have been bidding up the stock prices of companies connected to that boom. Mm-hmm. Now, the other thing that helped during the quarter was that some of this geopolitical risk that we're seeing in the Middle East actually moved in the right direction. Even though progress certainly isn't linear, and we've seen that just in the last few days here, tensions between the US and Iran eased somewhat in June after a 60-day memorandum of understanding was signed between the two countries. And as a result, oil prices came down, inflation concerns moderated a bit, and both of those things are good news for consumers and for corporate profits. Mm-hmm. And then here in Canada, our financial sector, which is now more than a third of our stock market, was a major contributor to returns. Banks performed very well during the quarter, and their stock prices were also helped out by the Office of the Superintendent of Financial Institutions deciding to reduce what is called the domestic stability buffer from 3.5% to 3%. Now, what that means is it allows Canadians or Canada's largest banks to put more capital to work, including through share buybacks and other shareholder-friendly initiatives.
Right. They don't have to have as much buffer on the books.
Exactly, yeah. So that basically got investors very excited about the banks and caused those prices to go up pretty significantly.
So did our traditional equity pool participate in that strength?
Absolutely, it did. So the Series I units of the Capstone Traditional Equity Pool returned about 8.4% in the quarter, and is now up more than 25% over the last 12 months. What was encouraging to me was that the performance came from a variety of managers and investment styles within the pool. One of the benefits of having a diversified multi-manager approach like we do with our traditional equity pool is that we're not relying on a single market theme or a single style of investing to drive returns. Different managers can contribute in different environments, whether that is large growth-oriented companies benefiting from trends like AI, or smaller value-oriented companies benefiting from improving fundamentals. Our goal with this fund is not to predict which part of the market will lead every quarter or every year, but rather to build a portfolio of high-quality managers and investment strategies that can participate across a wide range of market conditions.
Right. So we have another equity investment. It's a dividend-focused Canadian strategy, our Canadian equity income strategy. So did this strategy lag the AI-driven market?
Actually, CSIS, which is what we call that strategy, is doing exceptionally well. CSIS is built around owning high-quality Canadian businesses that generate strong cash flow and return capital to shareholders through regular dividends. And that approach, combined with pretty good stock picking, has actually served us well again this quarter. The CSIS composite returned about 7% during the second quarter and is up now roughly 33% over the last 12 months. Performance was pretty broad-based, but some of our strongest contributors this past quarter came from the financial sector. Not just our bank holdings, which I just mentioned what really drove them, but also other financial services companies like AGF Management and Power Corporation as well.
So Power Corp, I've always thought it was more of like a sleepy Canadian conglomerate. Is that the case?
Well, it kind of used to be.
Yeah.
For years, Power had a reputation as this unexcited an exciting Canadian holding company that own pieces of different insurance
Yeah,
companies
exactly.
and asset managers. We bought it about 2 years ago because we thought the story was starting to change. And then boom, all of a sudden, the stock returned 33% just this last quarter and up more than 70% over the past year. And people are now starting to ask what happened. Well, the answer is that the underlying businesses of Power have actually been performing extremely well. And investors are finally starting to recognize that value. The biggest piece of the story is Great-West Lifeco, where Power owns roughly 70% of the company. Great-West has arguably been the standout performer among large Canadian life insurers, benefiting from strong growth in their wealth management operations, retirement services, and employee benefits, particularly through its Empower division in the US. So that's been like one really big piece of the story. But then you also have Wealthsimple, where Power has a significant ownership stake. A lot of people have probably heard of Wealthsimple. It's
Very popular.
Yeah, it's quietly become one, well, not so quietly, I suppose, but it's become one of Canada's largest and biggest fintech success stories of recent years, with assets tripling in just the last couple of years to about 125 billion. So with Power, you've got this interesting combination of very stable cash-generating businesses on one side and a rapidly growing business on the other. And for a long time, the market looked at Power and saw boring conglomerate. Increasingly, though, investors are looking at it and seeing a collection of very attractive businesses that may have been significantly undervalued.
Right, and it's diversified, so you've got a lot of different things adding to your valuation.
Exactly.
So let's segue to south of the border. A lot of experts have been saying that the US stock market is extremely overvalued, based at least on historical valuations. Do you think that the US market is now in bubble territory?
It's a fair question.
The classic question.
Yeah,
Is it in a bubble?
It's. I think the answer is a little bit more nuanced than simply saying yes or no. If you look at the market as a whole, a lot of the gains that we've seen in the US over the last few years have actually been supported by some fairly strong earnings growth. Corporate profits and cash flows have been strong, and in many cases, higher stock prices have been justified just by better business fundamentals. Having said that, there are definitely pockets of the market where valuations have become pretty stretched. We saw this past quarter, particularly in some of the technology and semiconductor names benefiting from the enthusiasm around AI. Today, in fact, more than 20% of the S&P 500 index is trading at over 10 times annual revenue.
Not earnings.
Not earnings, revenue, which historically is really unusual and, in my opinion, kind of crazy. So I wouldn't characterize the entire market as a bubble, but I do think parts of the market are priced for perfection. And when expectations and valuations become that high, the room for error gets pretty small. And that's one of the reasons we're so committed to maintaining a value discipline. Our US equity strategy today trades at around 11 times forward earnings compared to about 17 times for the broader market. And we think that just gives our investors a little bit more room for error if economic growth slows or if market sentiment changes.
That makes sense. So artificial intelligence and the infrastructure build out, we've talked about that a little bit. It's obviously one of the biggest investment themes this year. It's perhaps the biggest investment theme we've maybe seen in our career. Have we at Capstone completely avoided it?
No, not at all. Not at all. So we don't admittedly own many of the names that people immediately think of when they think about AI. You know, companies like Amazon, Oracle, or some of the more expensive semiconductor stocks. In most cases, though, we just haven't been able to get comfortable with those valuations. But that doesn't mean that we're missing the theme entirely. One of the things investing teaches you over time is that some of the best opportunities come from the companies supplying the infrastructure behind major technological shifts.
Right, makes sense.
Yeah, rather than the companies grabbing all the headlines. For example, in Canada here, we own Finning International and have owned Finning for the last several years. It's the world's largest Caterpillar dealer. Now, before a single AI query can be processed, somebody has to build the data center, move the earth, pour the concrete, install the backup power systems, etc. And companies like Finning benefit and have benefited from that investment cycle. Similarly, in our US strategy, we own a company called Linde, which is one of the world's largest industrial gas companies. Semiconductor manufacturing requires enormous amounts of specialized industrial gases. Put simply, without those gases, you don't get chips, and without chips, you don't get AI. So while we may not own any of the obvious AI names, we do have exposure to some of the companies selling what are called the sort of picks and shovels of the AI gold rush.
So switching from the exciting to perhaps the less exciting. So let's talk a little bit about real estate. It has not exactly been the favorite or a great asset class for the last few years, and specifically Capstone's exposure to real estate in our non-traditional equity pool. It has a pretty material weighting in that holding. So talk to me about that. What have we seen? Where are we going?
Yeah, so I think it's a very important conversation to have because real estate has been one of the most challenging areas of the investment landscape for the past several years. Now, the whole purpose of NTEP, which is what we call the non-traditional equity pool,
which is like an alternative equity fund.
It is. It's the purpose of it is to provide clients with exposure to investments outside of traditional public equity markets. Historically, that's meant a combination of private equity, real estate equity, and in some infrastructure investments. And look, there's really no point sugarcoating it. The real estate environment across North America has been really difficult. The rapid increase in interest rates a few years ago changed the economics of real estate very quickly. Financing costs rose significantly, transaction activity slowed, and investors became much more cautious about valuations. Those factors put pressure on real estate markets across the different sectors and geographies. So as a result, NTEP experienced write-downs in a number of our legacy real estate investments that were made several years ago and are now approaching the end of their investment life cycles.
So was this unique to Capstone, or did we see this more broadly in other investments in this particular asset class?
Yeah, so I think overwhelmingly it's been a market issue. There's been a lot of broad-based adjustment across real estate markets. We recently saw some interesting data from the Bank of International Settlements that really illustrates the magnitude of what has happened. Looking at inflation-adjusted prices, Canadian residential real estate is down roughly 29% from its peak in the first quarter of 2022 until the first quarter of this year. Just to put that number in perspective, during the US housing downturn that coincided with the great financial crisis, real home prices in the US fell about 39% from their peak before eventually bottoming. Now, I want to be clear, I'm not suggesting Canada is experiencing or is about to experience a repeat of the US housing crisis that we saw 15 years ago.
Yeah, that was very different.
Yeah, circumstances are very different. The U.S. crisis was driven by excessive leverage, weak lending standards, and significant problems within the broader financial system. But the BIS data does highlight an important point. Canadian real estate has experienced a very significant adjustment. This has not been a minor correction. Interest rates have forced investors, lenders, and buyers to reassess valuations across the entire market. And interestingly, history also shows that real estate markets can recover after significant downturns. Following the US housing correction, as an example, inflation-adjusted home prices eventually recovered and actually rose over 63% over the following decade. Now, that doesn't mean Canada will follow the same path, but it does remind us that periods of significant weakness can also create opportunities for long-term investors.
Right. And I think it also reminds us that patience is necessary. Because
Absolutely.
you don't We always hear the principle, buy low, sell high. And this is a time where you just have to be a little bit patient. And we see it on our equity side of the portfolio. We just talked about non-traditional equity pool. We see it on the mortgage side of our portfolios. We see it in the mortgage pools. So given that environment, how does that change how we're thinking about real estate within the non-traditional equity pool?
Yeah, absolutely. So one of the benefits of managing a diversified alternatives portfolio is that we have the flexibility to adjust over time where we see the best opportunities. About a year ago, NTEP was roughly evenly split between private equity and real estate exposure. Today, that mix is closer to about 2/3 private equity and only 1/3 real estate. Now, that isn't because we believe real estate is permanently impaired as an asset class. Rather, it reflects the reality that different parts of the market are moving through different cycles.
Right. So are we starting to see any signs of conditions improving?
I think we're starting to see some early signs of stabilization. Things don't happen, very quickly in this asset class, but we are starting to see some green shoots, I guess you could say. Transaction activity has begun to pick up in certain areas. Financing markets are becoming more functional. And in many segments, buyers and sellers are starting to find more common ground on valuations. Now, I don't want to overstate that. We're certainly not declaring victory on real estate. There are still lots of challenges, particularly in areas where fundamentals are have structurally changed. But compared with a year or two ago, the environment definitely does feel healthier. The adjustment process has forced valuations to become much more realistic, and that can create better opportunities for investors who are disciplined and, as you mentioned, patient.
Yeah, patience being the key word here, because we know that investors who, buy low, sell high, that's always the recipe you want for success. And in this type of market, it's really tempting to exit a strategy when it's not doing as well, but having some patience and using some discernment is necessary. So let's talk about one specific aspect of the real estate market that I guess has been out of favor for a while, the office real estate sector. So, this is an area that's been in the headlines. We've seen a lot of negative press and news. We've also heard that some businesses are sending their employees back to work and looking for real estate in that sector. So, what are we seeing in the marketplace today?
Yeah, so office is probably the best example of why real estate has to be looked at on a case-by-case basis. The headlines around office real estate have been very negative for a while now, and in some areas, that's totally justified. Yeah. Older buildings in weaker locations, particularly those requiring significant capital investment, continue to face some real challenges. But the market is becoming much more differentiated. Higher quality buildings in strong locations have held up far better than lower quality assets. Companies still value having attractive spaces where employees can collaborate and connect, and we are seeing some signs that demand is stabilizing in the best parts of the market. The lesson here is that real estate is not one single asset class. A well-located, high-quality property with strong tenants is a very different investment from an aging asset facing structural challenges.
Right. So where does that leave a fund like NTEP within a client's portfolio today? The market's changed dramatically. This is not a traditional investment. It's in the alternative space. So what place does it have in a portfolio?
Yeah, I think the role of a fund like NTEP, and specifically NTEP today, is the same role that it's always had. NTEP is not designed to replace public equities. It is designed to provide exposure to different sources of return over the long term.
It's designed to be different.
Exactly.
Yeah.
Investments that may behave differently than traditional stock and bond markets. Now, there will be periods like we're seeing today when public equity markets are performing extremely well and alternatives may not look particularly exciting by comparison. But diversification works both ways. Like in 2022, as an example, when public equity markets experienced a significant decline, the Series I units of NTEP generated a positive return of more than 5%. That's exactly the role that we want these strategies to play within a broader portfolio. Right. Not necessarily to outperform every year, but to provide different sources of returns and to help build more resilient portfolios over a full market cycle.
Yeah, that is a really great point. Diversification is an element that is hard to apply when the going gets tough because you always want to have the winners keep winning. But it is necessary when things start moving around and you start seeing parts of the market respond differently than you expect. That's why diversification is important. So thank you very much, Paul, for coming today, for sharing
Thank
this
you.
information. And thank you for joining us on another edition of the quarterly review for Your Wealth Matters. And we will see you again next month.